Hello. Welcome to our essay series. So I have also uploaded all of these essay soft copy on my Telegram channel. So in case you like the notes, you can download the essay part from it from my Telegram channel. So let's continue from our audit in 100 pages. Today we will be doing our essay 240. Now what does essay 240 talk about? Essay 240 talks about auditors' responsibilities relating to fraud in an audit of financial statements. That is, if an auditor finds fraud or how to find fraud and what responsibility does the auditor have. So first we need to understand what exactly is fraud. So there are three important terms. One is it is an intentional act. It is an intentional act involving use of deception to obtain an unjust advantage. Use of deception. Okay, so fraud is an intentional act. Okay, so there are two types of misstatement. One is fraud and one is mistake. Now mistake is an unintentional act. However, your fraud is an intentional act. It is done on purpose, involving use of deception to obtain an unjust advantage. So you are tricking to have some advantage. Auditor is concerned with fraud that causes MM. MM stands for material misstatement. So if your fraud causes a material misstatement in the financial statements, then your auditor will be interested in that. Now there are sources of misstatement as to how does a misstatement occur. So first is your source of misstatement. So there are two sources of misstatement. Your first source of misstatement is fraudulent financial reporting. Now this is concerned mainly with journal entries, that is in the books. Anything and everything in the books will be included in fraudulent financial reporting. And your second is misappropriation of assets. Misappropriation of assets, you actually take the company assets in some way or the other. Now that can be your cash, that can be your table, chair, whatever, anything. So that is misappropriation of assets. So anything related to books of accounts will be covered in fraudulent financial reporting. So let's see our examples. First is your fictitious journal entries. Okay, so fictitious journal entries is basically fake journal entries that you have been passing in the book. That will be a misstatement. Your second is inappropriate assumptions. So while preparing accounts, we make a lot of assumptions. For example, depreciation, we have to assume whether we have to take SLM basis or WDV basis. So that is based on assumption as to how much my machinery is being used or how much my asset is being used. On that basis, I make an assumption as to what method of accounting I should follow. So that is your inappropriate assumptions. Third is your omitting, advancing, and delaying recognition of events. Some event has occurred. For example, one of your factory has come under fire, or there was a fire in your factory, there was a robbery in your factory. You have omitted the event as a whole. You have not shown anywhere in your financial statements. Then second is your advancing. Suppose you were to receive a big order. You are to receive, you are not yet received, but you have shown in the books to inflate your revenue. So you have advanced an event. That is, the event is bound to take place in the future, but you have already shown it in your books. And similarly with delaying, anything that has happened already happened, the event has already occurred, but you have not shown in the books in this period, you might show it later. So that is your delaying. And fourth is concealing facts that affect your financial statement. So anything that affects your financial statement and you are hiding it. Concealing means hiding. So if you are concealing any facts that affect your financial statement, that will be fraudulent financial reporting. Now second was misappropriation of assets. Misappropriation of assets, my first is embezzling receipts. Embezzling means stealing. And receipts are not your invoices. Those are not receipts. These receipts, we are talking about the money that the company is receiving. So any money that the company received and someone is stealing it or embezzling it, that is a misappropriation of asset. Second is you're stealing physical assets, that is assets that belong to the company. If you are stealing those, that will be called misappropriation of, that will come under misappropriation of assets. And third is using entities assets for personal use. Those assets belong to the company, but you are treating them as your own. You are using them for your personal benefit. Great. So you have to learn these, that there are two things under sources of misstatement. One is your fraudulent financial reporting and other is your misappropriation of asset. Okay. Now the next part is risks associated with non-detection of material misstatement. That is, how much risk do I have or what risk do I have if I do not detect a material misstatement? So your first point talks about risk resulting from fraud is higher than risk resulting from errors, because error is unintentional, that might get caught, but fraud is properly planned. Since fraud is properly planned, there is a proper thinking direction as to how this person can find ways to make money. Therefore risk resulting from fraud is higher because it is difficult to catch. Your second point is risk resulting from management fraud is higher than risk resulting from employee fraud. Why is this? Because management has more authority, they have more powers, and they are able to override some controls because of higher power. So risk resulting from management fraud is higher than risk resulting from employee fraud. This is because management have more powers to override controls. Okay. Now your third point is with regards to conditions or events which increases the risk of frauds, in which case it might be possible that the risk of fraud increases. Okay, as to what circumstances? So your first is discrepancy in accounting records, because if your ledger shows something else and your journal shows something else, this is a discrepancy. There is, it is possible that some fraud has taken place. If you watch Harshad Mehta scam, you might remember when he had changed the figure, since there was a discrepancy they noted it. Then next is your conflicting or missing evidence. Missing evidence might, you have, any example would be, suppose missing invoice. So you are showing a purchase but there is no invoice against it. This can be possible. This can mean that there is a possible fraud. Possible. Okay, so you will always have to dig deeper. But these are conditions or events which increase the risk of fraud. And your third is unusual relationship between auditor and management. So if the auditor and management are too friendly or if they are too close, it might be possible that they can collude, because auditor should always maintain independence. So therefore any unusual relationship between the auditor and management, that should be avoided. Now what is your fourth point? Your fourth point talks about management duties, that is what are the duties of management. Your management duty is, primary responsibility is prevention and detection of fraud by TCWG and management. So it says that the primary responsibility for prevention and detection of fraud is that of TCWG and management. It is not of auditor. Auditor's main responsibility is to provide an opinion. His main responsibility is not to find fraud. This responsibility stays with TCWG and management. Your second part is must have commitment and created a culture of honesty and ethical behavior. So the management, they themselves should, inside the organization, they should create a culture, they should create values among employees of honesty and ethical behavior, because once this is done at the grassroots level, it is difficult, or people will not engage in fraud because they will have a responsibility towards the organization, they will have honesty and ethical behavior. Great. Next is your fraud risk factors. Fraud risk factors as to when it is possible or when it is high that people will be motivated to do fraud. So if you see the third condition we saw, these are indicators of fraud. Your fifth condition is when people will be motivated to do fraud. That is, if there is incentive or any pressure to commit fraud, incentive is any benefit, if the person will receive any benefit, that is when he might do fraud. Your second is perceived opportunity to do so. That means the person can see that there is deficient in internal controls. He knows that even if I do something, I will not get caught by the current internal controls of the organization. That means he knows that I am safe to do so, I will not get caught. And third is your rationalization to do so. That means if the employee or whoever it is, he feels that I am doing the right thing, he does not feel he is committing a fraud, that is because it is based on his attitude or the nature of the person itself. If he feels that he is doing the right thing, he won't even get to know that he is actually doing a fraud. So that is based on attitude or nature of person. Okay. Next, we are coming to auditor's duty. So we already studied management's duty. Now we are studying auditor's duty as to what is the auditor's duty for fraud. So he first has to obtain reasonable assurance that financial statements as a whole are free from material misstatements. Okay, he has to obtain reasonable assurance. We can never have guarantee assurance, it will always be reasonable assurance. How will he do so? He will maintain an attitude of professional skepticism. Professional skepticism means having a questioning mind as to why what happens, everything should be known. Then next is circumstances indicate existence of material misstatement. If any circumstance, if he comes across any such item or such event or such journal entry which shows that there might be possible misstatement, material misstatement, then what do you have to do? Consider whether it is indication of fraud. So this is a misstatement. Now misstatements, this can be two ways we understood. It can either be fraud or it can be a mistake. If it's a mistake, we'll correct it, but if it's a fraud, we will have to dig deeper. So consider whether it is indication of fraud. And if it is a fraud, then you have to communicate to TCWG and management. You will have to let them know that boss, there is a possible fraud in your organization. And you will also have to tell the regulatory and enforcement authority if it is required by law. The regulatory and enforcement authority. Okay. Now your sixth point is if auditor is unable to complete engagement, if due to the fraud he is unable to complete the audit engagement, he should consider withdrawing from the engagement. When we say he should consider feasibility of withdrawing, that means he should consider, is it possible to withdraw from the organization right now? Is it worth it? If he withdraws from the audit engagement, then first point you have to discuss with TCWG and management that boss, I am leaving, I will not be able to do the audit. And second is he will have to report to appropriate person. For example, in case of public sector units, when the CAG appoints the auditor and the auditor in such a case is not able to do so, then he will have to inform CAG. So CAG will be the appropriate person over here. Now your seventh talks about risk assessment procedures as to what procedures should he perform to identify any frauds. So your A part talks about inquiring management and others within the entity with reference to process of identifying and responding risk. So you will inquire as to what is their process to identify and respond to risk. So first is asking ki boss, what do you do? Then second is inquire TCWG, that is those charged with governance, whether they have knowledge about fraud. You ask them, ki boss, has any fraud occurred before? Do you know of any fraud? Now why do you ask this? First is you will get to know how efficient their system is. Do they have policies and procedures in place to identify fraud? You will also get to know the pain areas as to where there is a possible chance of fraud, because of course they will know the business better than you. So they might have identified frauds which will help you dig deeper and find cases where there might be more frauds. Third is unusual or unexpected relations identified while performing analytical procedures indicating risk of material misstatement due to frauds. If you found any relationship, if you found any trends while doing your analytical procedures, this is one of your risk assessment procedure. And last is your any other information indicating material misstatement. Okay, so in 7th we identified what procedures do we have to perform. In the 8th point it says what are your responses. You have already assessed the risk. Now what is your response to the risk? So your first is your overall response. Overall response is assign personnel as per their capabilities. The team that you make, the audit team that you make, you will have to identify, you will have to decide which person to put in which area. So you will have to assign the personnel correctly. And the second is evaluate whether accounting policies indicate fraudulent financial reporting. That is, whether the client that you are auditing, whether their accounting policies are sound, are they correct? Do they indicate any fraudulent financial reporting, that is whether the policies itself are correct or not. We'll see whether the policies are being followed or not later, but first you have to see whether the policy itself was right or not. Then you have responses at the assertion level. So responses at the assertion level talks about design and perform audit procedures whose nature, timing and extent are responsive to assessed RMM due to fraud. So you will have to design and perform audit procedures. That is, you will have to create such audit procedures and you will have to perform those audit procedures whose nature, timing and extent are responsive, that is are as per the assessed risk of material misstatement due to fraud. So you have first identified what is your risk due to fraud. Okay, now once you have identified how much risk you have, you will have to identify processes, you will have to identify audit procedures, you will have to design such audit procedures and perform such audit procedures as per your risk of material misstatement due to fraud. And the last point is response to risk related to management override of controls. What does management override of controls mean? That is when the management has they have certain power for controls. For example, any expenditure over 50,000 has to be approved by management. Suppose this is a control. Now the management itself, they can override this control, right? For example, if they only enter in a transaction greater than 50,000, I entered in a transaction greater than 50,000, I only approved. I have overridden the control. So that is when I bypass or when I take advantage of the control, it is called overriding of control. So management in unique position to perpetrate fraud, that is get into fraud because of management ability to manipulate accounting records. They can change the accounting records. So auditor shall determine whether he needs to perform any extra audit procedures because of this risk, that is management may override controls. So auditor will need to check whether he has to do any additional, any extra audit procedures to check so that the management is not overriding controls. Great. And there is another limit with regards to fraud amount greater than 1 crore, less than 1 crore, that we will be covering in company audit. So in the essay, this is all. If you want, you can also watch that part of company audit where we talk about fraud. Okay, like the video and goodbye.